88 million ounces. That is all that is left. 88 million ounces of silver sitting in COMEX registered vaults in New York. The metal that every futures contract on the exchange is supposed to be backed by. And here is what most people have not yet connected. At the exact same moment, there are open futures contracts on that same exchange representing a theoretical delivery obligation of over 429 million ounces. Do that math. 429 million ounces promised, 88 million ounces available. That gap is not a data glitch. It is not a conspiracy theory. It is official CME Group data, published daily, and right now it is telling us something that Wall Street is not talking about loudly enough. My name is Alex Morgan. Welcome back to the channel. If you are new here, hit subscribe and ring that bell right now, because what we cover here is the kind of analysis that does not make it onto mainstream financial television. Today we are going deep into the COMEX silver inventory crisis, the numbers behind it, what caused it, and most importantly, where this market is heading next. Let's go. What COMEX is and why the numbers matter. Before we get into the data, let me quickly explain what COMEX is and why every serious silver investor on Earth watches it like a hawk. The Commodity Exchange Incorporated, COMEX, is the world's largest and most influential metals futures exchange, operating as a division of CME Group in New York. It is where the global benchmark price for silver is set every single trading day. When your bank, your ETF provider, or your jewelry manufacturer talks about the silver price, they are talking about COMEX. Inside COMEX, silver is stored in two categories. The first is called eligible silver, metal that meets exchange quality standards and is stored in approved vaults, but belongs to private owners like banks or ETFs who have not made it available for delivery. The second, and this is the one that matters, is called registered silver. This is the metal that is fully allocated, stamped, approved, and sitting ready to be physically delivered to anyone who holds a futures contract and demands actual silver bars instead of cash. Registered silver is the real ammunition behind every paper promise the exchange makes. And right now, as of February 19, 2026, COMEX's registered silver inventory stands at just 88.79 million ounces. That number fell by 3.36 million ounces in a single day. One day. 3 million ounces. How we got to 88 million ounces, the collapse in numbers. To understand how shocking this is, you need to know where COMEX started. In 2020, the exchange held 346 million ounces of registered silver. 346 million. Today that figure is 88 million. That is a 75% collapse in just 5 years. Let that sink in. 3/4 of the registered silver on the world's most important metals exchange has been physically drained away in half a decade. And the pace of that drain has not been steady. It has been accelerating violently in 2026. Official CME depository data from February 11th confirmed a single-day negative adjustment of 3.256 million ounces in the registered category, which broke the exchange below the closely watched 100 million ounce threshold for the first time. On the same day, vaults also reported withdrawals of more than 4.7 million ounces from the eligible category. That is nearly 8 million ounces leaving the system in 24 hours. The inventory drainage rate right now is running at approximately 785,000 ounces per day. Every single day, 3/4 of a million ounces of silver that was sitting ready for delivery the day before is gone. To make a bad situation worse, banks and exchange-traded funds transferred 95 million ounces from the registered category into the eligible category in the first half of 2025 alone, meaning that silver was quietly moved out of the deliverable pool and locked behind private ownership. It did not leave the vaults physically, but it effectively disappeared from the supply available to futures traders demanding delivery. The pool of truly deliverable, fully available silver is even smaller than the headline figure suggests. The delivery demand explosion nobody predicted. Now here is the piece of this story that should genuinely alarm every market participant. COMEX futures were never designed as a physical metal procurement market. They were designed as a hedging and price discovery tool. The assumption baked into the entire system since its founding was simple. The vast majority of traders would roll their contracts forward or settle in cash. Almost nobody would actually demand the silver. That assumption is now breaking down in real time. In January 2026, 49.4 million ounces of silver were delivered against COMEX contracts. That is 7 times the level of January 2024. 7 times. In just 7 days in mid-January, 33.45 million ounces were physically withdrawn for delivery. 26% of the entire registered inventory evaporated in a single week. By early February, the pattern continued. Of the 19.11 million ounces of February open interest, 18.72 million ounces were called for actual delivery, a 98% delivery rate. In a functioning futures market where contracts are supposed to roll forward, a 98% delivery rate is not normal. It is a sign that participants no longer trust the system to hold their silver on their behalf. They want the physical bars, in their hands, now. Buyers are no longer using COMEX as a hedging market. They are using it as a physical allocation mechanism, a place to queue up and take delivery of real silver before someone else does. That is a fundamental behavioral shift with enormous consequences for what comes next. March 2026, the number that keeps analysts awake at night. Which brings us to March 2026, and this is the chapter of this story that has the entire precious metals community holding its breath. As of early February, the March 2026 COMEX silver contract had open interest of approximately 429 million ounces. Registered silver available to fulfill deliveries, 103 million ounces at the time that figure was published, and falling daily toward 88 million as of February 19th. Run the scenarios. If March 2026 sees even 25% of open contracts stand for delivery, COMEX would need to deliver approximately 107 million ounces, more than the entire registered inventory may contain by the time first notice day arrives on February 27th. If delivery demand matches the January to February intensity of 50 to 70%, the exchange would face demands for between 200 and 300 million ounces against an available supply of 85 to 100 million ounces. The math does not work. There is no scenario where those numbers reconcile without either a dramatic repricing, cash settlements forced upon contract holders, or an outright delivery failure. FX Empire's registered CMT analyst has stated publicly that a COMEX delivery failure in March or May could be the catalyst that drives silver prices sharply above $200 per ounce. Senior precious metals analyst Bill Holter has warned that a delivery default would not merely be a silver story. It would expose the structural fragility of fractional reserve commodity futures trading and could trigger cascading consequences across gold and credit markets. And veteran market observers have gone further, stating plainly that if March 2026 brings what the data suggests it might, it could mark the end of COMEX as the world's primary silver pricing mechanism. Now, before I continue, I want to be balanced here, because this channel deals in data, not in doom. Gold-silver analyst Alan Hibbard has made the point that open interest is not a static stockpile. The vast majority of open contracts will roll or cash settle before first notice day, as they have in every prior delivery month. The exchange has tools available, including emergency margin hikes, which CME has already exercised, raising requirements by 60% to force leveraged speculators out of positions before delivery is demanded. A catastrophic default is not guaranteed, but the structural stress is real, the data is official, and the trajectory is unlike anything seen at this exchange in the modern era. Why is this happening? The 4 root causes. Let me give you the 4 forces that brought us to this point, because none of them are going away. The first is the 6-year structural supply deficit. The global silver market has consumed more silver than it has produced for 6 consecutive years. Global demand reached an estimated 1.2 billion ounces in 2025 against supply of roughly 1 billion ounces, a deficit in the range of 160 to 200 million ounces in a single year. The cumulative 6-year shortfall now stands at approximately 230 million ounces. That silver came from somewhere, and where it came from was exchange inventories. COMEX and the London LBMA have been the shock absorbers for that deficit, and they are running out of room to absorb any more. The second is China's export licensing regime. Since January 1, 2026, only 44 state-approved Chinese companies may legally export refined silver. China controls 60 to 70% of the world's refined silver supply. When you put bureaucratic friction on 60 to 70% of global supply in a market that was already running a deficit, you remove the safety valve that previously allowed Western exchanges to draw on Chinese metal to plug inventory gaps. That valve is now partially closed, and may close further. The third is industrial demand that simply will not stop. Solar panels, electric vehicles, AI data centers, 5G infrastructure, medical devices. Silver's industrial applications consume roughly 700 million ounces every year, and that figure is growing. Samsung has already moved to lock up mine output directly, signing an exclusive offtake deal for 100% of the La Paria mine's silver output for 2 years. Tesla's Elon Musk publicly stated the situation is not good for industrial users. Major tech firms are bypassing COMEX entirely and going straight to mines. When industrial giants start circumventing exchanges, it tells you they no longer trust the exchange to have metal when they need it. The fourth is a fundamental shift in investor behavior. Physical investment demand is forecast to surge 20% in 2026 to 227 million ounces, a three-year high. ETF inflows have been net positive in 9 of the last 11 months. Sprott Physical Silver Trust doubled its at-the-market equity program to $2 billion in January, signaling that one of the world's most credible precious metals institutions believes physical silver at current prices is worth acquiring at scale. And 57% of retail investors surveyed by Kitco News expect silver to trade above $100 per ounce before the end of 2026. Where does silver go from here? 3 honest scenarios. All right, the question every single person watching this video wants answered. Where does silver go from here? I'm going to give you 3 honest scenarios based on the data. Not the hype, not the doom, the data. In the bullish scenario, March 2026 delivery demand exceeds COMEX's available registered supply. The exchange is forced into widespread cash settlements, essentially paying contract holders in dollars instead of silver bars. That event shatters confidence in the paper pricing system globally. Physical premiums explode. Shanghai's already elevated premium over Western spot prices widens dramatically. ETF inflows accelerate as institutional money seeks physical exposure. The gold-to-silver ratio, currently around 62-1, begins compressing toward historical extremes of 15 to 20-1. If gold holds at current levels near $5,000, a compression to 30-1 gold-silver ratio alone implies silver at $160 to $170 per ounce. Gold-Silver's Alan Hibbard expects silver to reach $175 or more in 2026. FX Empire's technical analyst sees $200 as the post-default target. Peter Krauth, another veteran silver analyst, has called for $300 in what he describes as the coming frenzy phase. In the base case scenario, March passes without a formal default. The CME manages delivery pressure through cash settlements, emergency stock transfers, and continued margin hikes that force leveraged longs to exit. Silver oscillates between $75 and $100 through the first half of 2026, with significant volatility in both directions. The structural deficit continues. Physical investment demand keeps exchange inventories under pressure. Silver ends 2026 somewhere between $80 and $100. Elevated, volatile, but without the blow-off top that the bulls are calling for. In the bearish scenario, the Federal Reserve surprises markets by holding rates higher for longer, or geopolitical tensions ease unexpectedly, strengthening the dollar. Industrial thrifting, manufacturers using less silver per unit, accelerates faster than forecast. Leveraged speculators are flushed out by continued margin hikes, triggering a sharp sell-off. Silver retests the $70 support level identified by analysts at Mirai Asset. A sustained break below 70 opens the door toward the 60 to 65 range. Even in this scenario, the structural deficit does not disappear. It merely delays the next leg higher. So here is where we stand. 88 million ounces. That is the number. It dropped by 3 million ounces in a single day last week. February 27th is first notice day for March COMEX contracts. That is the date when holders of March futures must declare whether they want physical delivery or a cash settlement. Whatever happens on that date and in the days that follow is going to tell us a great deal about the health of the global silver pricing system and where this extraordinary market is headed next. This channel will be watching every data point, every CME warehouse report, every ounce that moves in or out of those vaults. Because 88 million ounces is not just a number, it is a countdown. And the question is whether the market reprices silver before that countdown runs out, or whether something far more dramatic forces it to. If this video gave you value, and I genuinely hope it did, please hit the thumbs up right now. Share it with anyone you know who is watching the metals market, because this is information they need. Subscribe if you have not already, hit that bell, and I will see you in the next one with the latest data as this situation develops. I'm Alex Morgan. Stay sharp, stay informed, and remember, in a market like this one, the people who understand the data earliest are the ones who are best prepared for what comes next. Rection 2026.